Welcome to my course on double entry bookkeeping. This is the first lesson, so I'm aiming to provide a gentle yet important introduction to financial accounting and bookkeeping. The learning goals are for you to be able to explain the purpose of a bookkeeping system, identify which organisations need to legally produce financial statements, state what needs to be reported as a minimum, and name 2 financial statements connected to the double entry bookkeeping system that we will be learning about. At level 2 in most bookkeeping and accounting qualifications, you learn about how to process business transactions in the double entry bookkeeping system. Its purpose is to enable those transactions to be summarised in the form of financial statements. Yet they're often not taught until level 3 and 4. It's not surprising that many find it confusing. It's like being asked to put a jigsaw puzzle together without ever seeing the bigger picture. For double entry to make sense, it's essential that you're familiar with 2 key financial statements. So that's why we'll spend some time learning about them before looking at the intricate detail of the double entry bookkeeping system. Financial statements are reports that tell us about how well a business is doing, whether it's profitable and whether it's financially stable. Morrison's is a limited company, so they are legally obliged to produce these reports so anyone, including the public, can see how they're doing. Not all organisations are legally obligated to produce financial statements. Let's take a look at the legal structure of a few different organisations so you can see why. Let's say you wanted to start a business. Initially, you'd most likely be a sole trader, or if it's with other people, a partnership, which means you're all self-employed. When you're self-employed, there's no legal separation between you and your business. You are the business. You're personally held responsible for your own success or failure. So if the business were to fail, you're responsible for finding a way to pay the business's debts. The things you own and your personal finances are not protected. For this reason, there's actually no legal obligation for self-employed people to prepare financial statements. However, you'd still be required to keep bookkeeping records so that you can comply with other legislation. For example, you're likely to be required to pay tax on your income. You might employ people and have to account for the tax collected on their income, or be required to charge VAT. That's a tax on the sale of goods and services. If you're in the UK, you can find out what your obligations are on the government website. After you've been trading a while as a self-employed person, you might want to protect your own assets and finances. You can do this legally by incorporating your business as a private limited company or a limited liability partnership. These business structures provide limited liability, meaning that if the business fails, you only stand to lose what you've invested, and your personal assets and finances are protected. It's easy enough to do, but your legal responsibilities change. Limited liability businesses are legally obliged to prepare financial statements, as well as file them every year with Companies House, the UK's regulatory body. When companies are held accountable to those that are affected by their operations, it encourages them to operate responsibly. Anyone can view the accounts of any limited company on this website. Organisations that use public money must also be held accountable. So, not-for-profit organisations such as charities, schools, hospitals, the emergency services and local authorities are also legally obliged to prepare financial statements and file them with other regulatory bodies. In each lesson, you'll have an opportunity to test whether you're understanding what's been shared. I'll ask you to pause the video so that you have time to read and answer the question. Press play when you're ready to see the answer. Can you pause the video now? Limited liability organisations and organisations that use public money are legally obliged to produce financial statements. Sole traders and ordinary partnerships are not, although many do, as the reports help them make better financial decisions. Every organisation that is required to produce financial statements, as a minimum, has to show the difference between income and expenditure. For a profit-making business, the difference is profit or loss. An overview of the organisation's financial structure and its health. Financial reports may look different to the untrained eye because there are many differences in terminology, the way they're presented, and the level of detail provided. It's all dependent on the organisational structure and the accounting rules and principles that they are required to adopt. To avoid having to use so much different terminology when learning double entry, we will use terminology typically used in small profit-making businesses. We'll call the financial statement that shows the difference in income and expenditure and whether the business has made a profit or loss, the statement of profit or loss. And the financial statement that shows the overall financial health of a business, the statement of financial position. Can you pause the video again to give yourself time to read and answer the question? The statement of profit or loss shows whether a business has made a profit or loss, and the statement of financial position shows the financial health of a business. It's essential you have a basic understanding of the financial statements to be able to have a proper understanding of double entry. So in the next lesson, we'll be learning about the statement of profit or loss.